Today we're going to talk about tariffs, exemptions, Apple, Nvidia, and much more. AI tools were used in the creation of this video. For more details, see the video right now and the description below.
Welcome to the deep dive. Today, we're trying to cut through some of the noise around the Trump administration's latest tariff moves. We've got a stack of reports here, MarketWatch, CNBC, CNN Business, mostly from April 12th, 13th, 2025. And our mission, really, in this deep dive is to get a handle on how these policies are actually hitting the ground, specifically in tech and auto and what the wider ripples might be for the U.S. and global trade, all boiled down. So let's just jump right in.
Yeah, it's interesting. What's immediately striking, I think, is how these tariffs were sort of rolled out quite broadly at first, but then almost immediately we started seeing these very specific exemptions getting carved out. It makes you wonder about the kind of immediate pressures, maybe, or the downsides the administration quickly saw they needed to avoid.
Exactly. And the tech industry, it seems like they've caught a bit of a break here. MarketWatch, CNN Business, they're both calling it a major win for giants like Apple and Nvidia. So what exactly are these exemptions? What do they mean for, people listening?
Well, after that initial announcement, which was a pretty hefty minimum tariff, 145% on Chinese goods, the administration put out guidance. And this guidance specifically exempted smartphones, laptops, and even the equipment used to make computer chips. Now, that's a pretty significant carve-out. But it's important to note, this doesn't touch that separate 20% tariff on Chinese goods linked to fentanyl. That's still there.
Right. Okay. So not a total rollback, but a very targeted adjustment. And this exemption, it sounds like it was especially critical for Apple, wasn't it? We were hearing all sorts of things about potential iPhone price hikes before this. What was the story there?
Oh, absolutely. I mean, given that Apple does the vast majority, well, something like 90% of its iPhone production and assembly in China, those initial tariff announcements really sent some alarm bells ringing. Analysts were genuinely concerned. They figured Apple would face a really tough choice, either, significantly jack up iPhone prices, which obviously could hammer demand, or they'd have to just swallow those massive tariff costs themselves, taking a huge bite out of profits.
Yeah.
MarketWatch even pointed out Apple stock dropped 11% between that first announcement on April 2nd and last Friday's close. That really shows you how worried investors were. It was a big deal for anyone holding Apple stock or thinking of buying an iPhone.
Ouch. Yeah, 11% is definitely going to get your attention. So this exemption must have felt like a huge sigh of relief then.
Massive. Analysts at Wedbush Securities CNN Business reported this. They called the exclusion, and I quote, the best news possible for tech investors. They specifically mentioned Apple, Nvidia, Microsoft as, the big winners here. The sheer relief you can sort of read in their statements.
Yeah.
It really underlines how big that initial threat felt.
Makes total sense. I mean, I saw Counterpoint Research estimated Apple only had maybe 6 weeks of iPhone inventory here in the U.S. After that, without this exemption, you probably would have seen prices jump noticeably. That could have really hit consumers right in the wallet, couldn't it?
Precisely. A sudden big jump in the price of something like an iPhone. It's so widely used. That could easily have had broader knock-on effects, on overall consumer spending, maybe even pushing up inflation expectations for everyone.
Now, even with these exemptions, the White House is apparently still saying Trump will keep pushing tech companies to, bring production back home. They're talking up trillions in investments they say they've secured already, Apple, TSMC, Nvidia mentioned, and ongoing efforts to get more manufacturing onshore. It kind of feels like they're saying, okay, you get a break now, but the pressure's still on. What's your read?
That's a very good way to put it. It does feel like a bit of a balancing act. The administration is probably trying to ease some immediate economic pain, avoid that sticker shock on phones, but still keeping that longer-term goal of boosting U.S. manufacturing front and center. Remember, Trump himself mentioned possible exceptions earlier, suggesting maybe 10% is a kind of floor. So there might be some flexibility there depending on how things play out.
And it's not just finished goods like phones, right? The reports say semiconductors, microchips, things heavily made in Asia are also exempt. That seems like it could have a pretty big impact across the whole tech landscape for everybody listening.
Oh, definitely. This exemption is likely a significant plus for the big chip makers. Your TSMCs, Samsungs, SK Hynixes of the world. Although, it's worth remembering, Trump has kept criticizing that Biden administration grant to TSMC for their plant in Phoenix. He's been pretty consistent saying, companies that don't build plants here will face tariffs. So there's still potential for, let's say, future friction and future costs in the tech sector down the road.
Yeah, it feels like the ground keeps shifting. Now, BBC News had an interesting take. They called these exemptions, especially for smartphones, a significant trade war retreat. What does that really mean for us?
Well, from a, let's say, pure trade policy view, it's kind of hard to argue with that description. Smartphones are the single biggest category by value of stuff on China ships to the U.S. So to pull them out from under such a massive tariff, it suggests they recognize the potential for really serious economic disruption, a direct hit to consumers. The BBC even mentioned estimates that a 125% tariff could have pushed iPhone prices towards almost $2,000.
$2,000. Wow. Almost double. That really frames the potential impact, doesn't it?
It really does. That kind of jump would almost certainly have caused a huge backlash.
MarketWatch also mentioned Pete Navarro, the White House trade advisor, known for being pretty hawkish on tariffs. He seems to have been sidelined a bit, with Treasury Secretary Scott Bessent taking more of a lead on trade talks. Could that signal maybe a shift in the administration's overall approach for us?
It certainly could. Navarro was generally seen as pushing for, a more aggressive use of tariffs across the board.
Hmm.
Bessent getting more involved might suggest a slightly more, let's say, pragmatic path,
Hmm.
maybe prioritizing economic stability and negotiation over just punitive measures. For people listening, that could mean a slightly less volatile trade environment, maybe, at least in the short term.
And according to Capital Economics, just under a quarter of China's total exports to the U.S. are now exempt from that huge 125% rate. They also pointed out that other places with big electronics manufacturing, Taiwan, Malaysia, Vietnam, Thailand, they're going to benefit too. So it's not just a U.S.-China thing, is it?
That's a really crucial point. Yeah, the spotlight's obviously on U.S.-China, but these exemptions ripple out. They affect global supply chains, trade flows everywhere. It looks like the administration is trying to avoid massive disruption while still trying to keep some leverage. For everyone listening, it just highlights how interconnected everything is globally.
It's quite a contrast, though, when you look at allies like the UK. MarketWatch noted they're facing a 25% tariff on cars. Even though the UK actually runs a trade deficit with the US, it really underlines that these tariffs aren't purely about trade imbalances, are they?
Exactly right. The thinking behind these tariffs seems pretty multi-layered. You've got national security mentioned, reshaping supply chains, maybe domestic politics playing a role too, and the impact hits different partners very differently. It's not always just about who sells more to whom, which, yeah, can make the logic a bit confusing sometimes.
Okay, let's shift gears then. Let's talk about the auto industry because the news from CNBC paints a very, very different picture there. They're reporting on ongoing 25% tariffs on imported vehicles. It doesn't sound like the car sector got the same kind of relief as tech. What's this mean if you're, say, thinking about buying a car?
That's right. Those 25% tariffs on imported vehicles, they kicked in April 3rd. They're still on. And yeah, analysts are forecasting some pretty major fallout. CNBC's report talks about expectations of vehicle sales dropping by millions, higher prices for both new and used cars, and overall costs for the industry going up by over $100 billion.
Yeah.
So for anyone listening, yeah, it's strongly suggest buying a car is about to get noticeably more expensive.
Over $100 billion in extra costs. That's just a massive number. Where are these estimates coming from exactly?
Well, Boston Consulting Group put the potential added annual cost somewhere between $110 and $160 billion for the whole industry. The Center for Automotive Research, they focused just on U.S. automakers and projected $107.7 billion in increased costs for them alone. That's $41.9 billion just for GM, Ford, and Stellantis combined, potentially. And it's really important for people to understand these analyses factor in both the existing 25% on imported vehicles and the upcoming tariffs, same amount, 25% on imported auto parts, which are supposed to start around May 3rd. So it's kind of a double whammy for the auto sector and ultimately probably for car buyers and even people needing repairs.
Right, so it's not just the sticker price on an imported car. It could also be the cost of fixing your domestically made car if it uses imported parts. And Goldman Sachs seems to think these costs will mostly get passed on to consumers, right?
That's certainly their expectation.
Yeah.
Goldman analysts think net prices for new cars in the U.S. will probably go up by, say, roughly $2,000 to $4,000, and that's likely within the next 6 to 12 months as car makers adjust. So, yeah, if you're planning on buying a new car soon, you might want to factor that potential hike into your budget.
And we're already seeing some interesting reactions from the car companies, according to CNBC. Domestic makers are apparently offering employee pricing to shift inventory, while some foreign manufacturers are doing, well, quite different things. What does this mean for the choices people have?
Exactly. Some foreign automakers, like Jaguar Land Rover, have reportedly just stopped shipping vehicles to the U.S. entirely. probably because they figured they just can't absorb that 25% tariff and still compete here. Others, like Hyundai, have announced they're freezing price increases, maybe temporarily, perhaps to hold on to market share, ease consumer worries a bit. So these different strategies mean, yeah, you might see fewer options from some brands. Others might try to hold steady on price for a bit to attract buyers.
And all this seems to be landing just as consumer confidence is taking a knock. That University of Michigan survey showed inflation expectations in April hit their highest since, what, 1981? It's hard not to see a connection between tariffs, rising prices, and just how people are feeling about the economy overall.
The timing certainly makes you think there's a link.
Yeah.
Higher prices for big-ticket items like cars, that can definitely affect how people feel about the economy, their expectations for future inflation. Telemetry, they're an auto analysis firm, they even project these higher costs, could lead to maybe 2 million fewer vehicles being sold each year in the US and Canada. That kind of drop in sales, that would have significant ripple effects across the whole economy. It could impact jobs, related industries, things that might affect people listening directly or indirectly.
And let's not forget, new cars were already averaging nearly $50,000 Cox Automotive figures even before these new tariffs hit. And that's without even considering the higher interest rates for car loans these days. So these tariffs are just piling another cost layer onto what was already a very expensive purchase for most people.
That's a critical point. Yeah. Cox Automotive estimates imported cars could see an extra $6,000 tacked on because of these tariffs. And even cars assembled here in the U.S. might go up by about $3,600 because of the tariffs on imported parts. And like you said, this is all on top of price increases we already saw from the earlier steel and aluminum tariffs. So the cumulative hit to the consumer's wallet could be really quite substantial.
It paints a pretty tough picture for the auto industry and, yeah, anyone needing a car soon. Okay, let's zoom out even further now. Let's look at the broader economy. CNBC also reported on growing worries about a potential outflow of U.S. assets as Treasury yields rise and the dollar weakens. This feels like a much bigger issue that could impact people in lots of different ways.
It is a significant concern, and the recent market action has been, well, quite unusual. Since that April 2nd tariff announcement, the S&P 500 is down over 5%. We're seeing more volatility. But what's really striking is that both the U.S. dollar and U.S. Treasury bonds are sliding at the same time. Normally, when things get uncertain, investors run to the safety of treasuries, and that tends to boost the dollar. The fact that both are falling suggests maybe a shift in how investors view U.S. assets. And that could eventually affect, the value of people's investments' overall financial stability.
Right. CNBC mentioned the 10-year Treasury yield briefly popped above 4.5%, and the U.S. dollar index hit a 3-year low. Those are pretty big moves in a short time. What does that signal, practically speaking?
It does, and it's prompting some serious thinking. Strategists at Deutsche Bank are even talking about a reassessment of the structural attractiveness of the dollar as the world's main currency. They use the term rapid de-dollarization. Now, that might sound a bit abstract, but for people listening, it could eventually mean the dollar buys less overseas, making imported goods potentially more expensive down the line.
And the Minneapolis Fed president noted the dollar is falling despite the tariff hikes. That seems counterintuitive, suggesting other forces are at play beyond just trade mechanics, maybe influencing how investors see the U.S. economy and, potentially, our financial futures.
Exactly. It points towards maybe a change in investor preferences, a different calculation of risk around holding U.S. assets. And this also brings up the specter of tariff-driven inflation. If tariffs push prices up generally, that could make it harder for the Federal Reserve to cut interest rates, which in turn could keep borrowing costs high for mortgages, loans, things that affect everyone.
BlackRock CEO Larry Fink also chimed in, worried about U.S. companies maybe facing discrimination overseas, a potential big image issue for the U.S. That really brings home the wider geopolitical side of these policies, doesn't it, for us and for U.S. businesses globally?
It does. Tariffs often provoke retaliation from other countries. They create trade friction that can hurt the international operations, the reputation of U.S. companies, which could hit their bottom line, maybe even lead to job losses eventually that could affect people listening. And also, those rising Treasury yields, they directly increase the cost for the U.S. government to borrow money. That adds to the national debt, potentially impacting government spending and maybe our tax burden long term.
Okay, turning quickly to how other countries are reacting. CNBC had some insights on Japan's view. Interestingly, it sounds like they're focusing on strengthening their own economy, not really hitting back directly against the U.S. tariffs. What does that tell us about the global picture we're all part of?
It's a notable stance, yeah. Japan's ruling party policy chief basically said intentionally dumping their U.S. Treasury holdings wouldn't be the right move for an ally. Instead, they're emphasizing boosting their own industrial competitiveness to strengthen the yen, which has been weak. However, they do have trade talks coming up with the U.S., and currency policy is expected to be a big topic, so there'll likely be pressure on Tokyo to prop up the yen somehow. It just shows that complex web of relationships. Different countries choose different paths in response to U.S. policy, and those choices can indirectly affect us through trade and currency movements.
And Taiwan, obviously a huge player in tech, they held their first trade talks with the U.S. They're facing a hefty 32% tariff on semiconductors, so vital for them and for the tech we all use every day.
Yes, and while Taiwan did voice concerns about, the fairness of those tariffs, they apparently moved fast to propose solutions. Things like maybe a zero tariff setup, commitments to buy more U.S. goods, invest more here. Their sort of proactive approach really underlines how crucial the U.S. market is for them, especially in chips, being home to TSMC. Their willingness to negotiate might potentially soften some of the negative impacts for consumers buying electronics.
So as we sort of wrap up this deep dive, it feels like a really intricate, fast-moving picture. You've got the tech sector getting some, well, significant relief, for now anyway, on key stuff. Meanwhile, the auto industry is scaring down some serious headwinds from these ongoing tariffs, likely hitting consumers' wallets. And then zooming out, there are these broader anxieties about the U.S. economy, the weak dollar, rising yields, plus all these different international reactions and negotiations still playing out. It all feels very connected and leaves a lot of uncertainty hanging in the air for everyone.
Absolutely. The targeted nature of the exemptions, the continued squeeze on autos, the signals from financial markets, it all points to a really complex mix of economic goals, political aims, maybe unintended consequences too. The long-term effects of all this are still very much unfolding. They'll definitely continue to shape the global economic landscape that we all operate in.
So, considering all these developments, what long-term shifts in global supply chains and international economic relationships might we really expect to see? And maybe what role will individual countries and major companies play in navigating this evolving environment? It's definitely something to keep thinking about, maybe explore on your own. Thanks for taking this deep dive with us today.